Hey everyone, today's video is mostly for my US viewers as we approach another tax filing season, but even if you're watching from somewhere else, you still might find it interesting. As you may know, there are some important tax changes coming up for the 2025 tax filing season. I'm going to break down what you need to know. We're going to look at what's changed, what's staying the same, and how this may impact your tax return, whether you're an employee, a retiree, or a small business owner. We'll go over what matters most, things like the 1099-K reporting changes, the no taxes on tips and overtime income, the new standard deduction amounts, child tax credit increase, and increase to the state and local tax deduction, also known as SALT, among other things. President Trump and Scott Bessent says that you'll get your biggest refunds you've ever seen. We'll figure out if this will be the case for you or not, and hopefully avoid any surprises at tax time. Let's get to it. Hi, I'm Noel Lorenzana. I'm a CPA who actually does taxes. If you need help with your taxes, feel free to reach out to see if we'd be a good fit. The bill that changes your taxes. Before we talk about the specific tax changes, it helps to understand a specific tax law change. Back in 2017, Congress passed the Tax Cuts and Jobs Act, often called TCJA. That law made big changes to the tax code, things like lower tax rates, a doubling of the standard deduction, changes to itemized deductions, and elimination of personal exemptions. But here's the key part that many people never realize. Most of those changes were temporary, meaning they were scheduled to sunset or expire at the end of 2025. If Congress did nothing, the tax rules would have automatically reverted back to what they were before 2018. And those were higher taxes, lower standard deductions, different rules across the board. The One Big Beautiful Bill signed into law on July 4th, 2025 was designed to stop that from happening. In simple terms, this law did two main things. First, it makes many of the current tax rules permanent so they wouldn't expire. Second, it adds a handful of new provisions and adjustments that affect certain groups like workers who earn tips or overtime, families with kids, seniors, and some business owners. Some of these changes apply to your 2025 taxes, which you'll file in early 2026. Some of the other changes fully take effect starting January 1st, 2026. That's why this can feel a little confusing. We're in a transition period where a few things change now and more changes come shortly thereafter. The good news is this. For most people, this is not a total rewrite of the tax system. Your return will probably still look familiar to you, but there are enough changes that it's worth paying attention this year. What's not changing? Let's start with some good news because not everything is changing. In fact, a lot of what you're already used to is staying the same. And that's important to know, especially with so many headlines floating around. Here's what's sticking around. The higher standard deduction is staying and actually going a little bit higher. For 2025, it increases slightly to $15,750 if you're single, $23,625 for head of household, and $31,500 if you're married filing jointly. These amounts will keep adjusting for inflation every year moving forward. So for most people, especially those who don't itemize deductions, that's a real benefit. Next, the current lower tax rate brackets are staying. They're not reverting to the higher rates we had before 2018. That was one of the big fears if the TCJA expired. This bill keeps things as is, which brings some welcome consistency. And then the personal exemption amounts remain at zero. Now, I know that sounds like a negative, but this hasn't been around since 2018, so nothing is really changing here. It's just now confirmed as permanent. In other words, if you've been filing your taxes the past few years and things have looked fairly predictable, they'll continue to feel that way for 2025 and even 2026. That kind of stability is good to have, especially when planning ahead. But there are a few new additions that could help or surprise you. So let's go over those next. New changes for 2025 and retroactive updates. For tax year 2025, these are the changes that could affect the return you file in early 2026. They're retroactive, meaning they already apply to the tax year 2025. Let's go through the main ones. Number 1, the child tax credit is increasing. If you qualify, the credit is going up from $2,000 to $2,200 per child. That extra $200 may not seem like much, but if you have multiple children, it adds up. And this new amount is permanent, not just a one-year bump. 2, a new senior deduction is now available. If you're 65 or older, there's an additional $6,000 bonus deduction available on your 2025 return. It doesn't matter if you itemize or take the standard deduction, it's additional. There is an income phase out. It starts to go away if your modified adjusted gross income is over $75,000 for individuals or $150,000 for married couples filing jointly. This deduction will be available for a few years, and it's a nice benefit for retirees who often live on fixed incomes. 3, no tax on certain tips and overtime, up to a limit. This one made headlines, so let's break it down. If you earn tip income, there's now a potential deduction of up to $25,000. If you earn overtime, you may be able to deduct up to $12,500. But, and this is important, these amounts phase out. If your income is too high, the limit starts at $150,000 for individuals and $300,000 for couples. Now, not everyone qualifies for the tip deduction. Your job needs to customarily and regularly receive tips and be designated as such by the Treasury Department. And you'll need to document your tip or overtime income properly to claim this. It won't be automatic, so if this applies to you, keep good records. Number 4, SALT deduction increases. The limit on state and local tax deductions, also known as SALT, goes up to $40,000, and that starts in 2025. This goes up from $10,000. This will get more people to itemize their deductions on their tax return, which usually means a bigger tax refund. It's especially beneficial if you're in a high tax state like New York, California, or Illinois. Do note that the amount does phase out for incomes over $500,000. 5, a new savings option for children, Trump accounts. The new tax law creates a federal savings account for children, commonly referred to as a Trump account. All U.S. children under 18 will be eligible once the program launches. Children born between January 1st, 2025 and December 31, 2028 are expected to qualify for a $1,000 federal contribution, assuming they have a valid Social Security number. Based on current guidance, this contribution will be claimed through Form 4547, though the IRS and the Treasury are still finalizing implementation details. These accounts are designed for long-term savings. Funds are invested in low-cost index funds, grow tax-deferred, and withdrawals later in life are generally taxed as ordinary income. If you have a newborn or planning to, this is something worth watching closely. Next up, we'll talk about the one form that's caused a lot of confusion over the past few years, the 1099-K. Some clarity is finally here. 1099-K reverts back to the old rules. This is a tax form you might receive from apps like PayPal, Venmo, Cash App, or Stripe if you've received payments for goods or services. For a while, the IRS was trying to lower the threshold dramatically down to just $600, which upset a lot of people, especially for those selling personal items on eBay or simply splitting dinner with friends. But here's the update for 2025. The reporting threshold goes back to the old rules. Now you must receive both 200 transactions and over $20,000 total in payments. Only if both are true will a 1099-K be issued. So if you're just using a payment app casually, like selling some used furniture or getting paid back for lunch, you shouldn't get one. And that's a good thing. Fewer unnecessary forms and less stress at tax time. But here's something I always remind my clients. Just because you don't get a form doesn't mean it's not taxable. If you're earning income, even without a 1099, you're still required to report it. The form doesn't create a tax, it just reports one that may exist. That's especially true for freelancers, side hustlers, and anyone running a small business. Just know that if you get paid through digital platforms, it's still income. But again, for 2025, the reporting burden is going back to normal. This is one of those changes that actually makes things less complicated, and that's a win. Now, if you do get a 1099-K while being under the $20,000 and 200 transaction threshold, don't freak out. It may or may not be taxable. It's beyond the scope of this video, but if you need help sorting it out, do reach out to a tax professional for help. Quick overview of business changes. All right, for those of you who run a business, are self-employed, or even have a side hustle, the new law brings back a few helpful provisions worth knowing about. I'll keep this high level, but here's a quick rundown of what's changing for businesses and business owners starting in 2025. 1. Bonus depreciation is back to 100%. That means if you buy qualifying equipment or assets, you can write off the full cost in the year you buy it, not just a portion of it. That was a big part of the 2017 tax law, and now it's being restored, which can help businesses lower their taxable income more aggressively. 2. R&D expense can now be deducted upfront again. Instead of having to spread out research and development costs over several years, businesses can expense them fully in the year incurred. This is a big change for companies in tech, manufacturing, or product development. 3. Section 179 limits are increased. This provision lets small businesses write off equipment purchases immediately. The limits are going up, so more of your spending can be deducted right away. These changes are designed to boost investment and allow more upfront deductions. If you're running a business, even part-time, this could benefit you. What you can still do. Now that the year is over, a lot of people think tax planning is done. It's actually not. Let me walk you through a few planning opportunities that you may still be able to make. Number 1, retirement planning still matters. Even after year end, you may still be able to contribute to an IRA for the prior tax year. Traditional IRA contributions are available until April 15th and can lower your taxable income if you qualify. Roth IRA contributions can be made by the same deadline. They don't give you a deduction, but they do grow tax-free until retirement. If you're self-employed, there may also be options like a SEP IRA or solo 401k, depending on how your business is set up. The big idea here is retirement planning doesn't stop on December 31st. And the earlier you plan, the more flexibility you have. Number 2, consider a backdoor Roth IRA. If you make too much money to contribute directly to a Roth IRA, there's a legal workaround called a backdoor Roth conversion. In simple terms, you contribute to a traditional IRA, then convert that to a Roth. You may owe some tax on the conversion, but it gives higher income earners a way to build tax-free retirement savings. I've got a full video that walks through this, how it works, and I'll link that up here. It sounds complicated, but done correctly, it's one of the most powerful long-term tax moves available. 3, HSAs, still one of the best tax tools available. If you had a high deductible health plan, you might still be eligible to contribute to an HSA for last year. HSAs are powerful because of their triple tax benefit. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. The tax code isn't always fair, but knowing the rules helps you play the game a little smarter. So after everything we just covered, here's the question. Should you do your own taxes this year? If your situation is very simple, no kids, no business, one W-2, you're probably fine using software like TurboTax. But if you've got a little more going on, multiple income sources, investments, self-employment, new deductions, or just questions about these new tax changes, this might be the year to get real professional help. Not because taxes are scary, but because there's a lot of moving parts in 2025 and 2026. And a good tax professional can often save you more than they cost just by helping you avoid mistakes, missed credits, or phase outs you didn't even realize applied to you. Let me know in the comments if you have any questions and if you plan to DIY your taxes this year. And if you want to ensure you're capturing all your tax deductions, you can download my tax deductions cheat sheet for free. I'll link that down below. Thanks so much for watching, and I'll see you in the next video.